My name is Nigel Cohen. I'm presenting the Sunshine Courses Accounting module. This module is on fixed assets. And what we're going to be covering is the principles of what fixed assets are, the basis of how those costs are allocated over the life of the asset, the accounting entries that put into practice that allocation, the reporting, particularly statutory reporting, and then we're going to cover a few practical tips. So the principle of fixed assets is that we spend money on buying assets that last typically a lot more than a year. Technically, they only need to last a year or more to be described as fixed assets. But we go out and spend money on equipment such as a car or a property. And in the example we're going to be showing in this module, we're going to be looking at the shop fittings that a retailer, clothes retailer, would buy in order to display clothes. So that cost lasts for 3, 4, 5 years, depending on the asset. If it's a car, typically it lasts for 2, 3, 4 years. If it's fixtures, a retailer will typically have them for about 5 years, and then they'll need to renew them or replace them. And if you're talking about, for example, a building, sometimes the length of the asset can last for 10, 15, 20, 50 years sometimes. So during this session, we're going to be specifically looking at how we account for fixed assets, the purchase of shop fittings, which cost £120,000, and those assets last 5 years. So remember, the reason we're doing this in the first place is that we need to match our costs against our revenues. Now, whilst we've got the fittings, we're going to get people coming into the shop over whatever the life of the assets are, but in this case, we're just going to assume it's a 5-year period. And during that 5-year period, we're going to receive revenues from the sale of those of the clothes that are on the fittings. And the fittings create ambiance in the store, as well as providing the opportunity for people to physically get the stock and to take it and to buy it. So those costs of £120,000 last for a 5-year period. So the question is, how do we account for the apportionment of the cost, and how do we allocate it in the accounts? How do we mechanically put the adjustments through to effect what we need to do? Well, in the example we've got here, year 0, remember, is the accounting way that we talk about the start of any accounting period. And then the rest of the columns are what happens in year 1, then year 2, then year 3, and so on. And right at the very, very beginning of this period, we spend £120,000 to buy these assets. And in this particular example, we're going to allocate the cost equally over a 5-year period. So the way we simply do that is to divide the £120,000 by 5, which is £24,000, and each year we're going to allocate that to the accounts to reduce that £120,000 over the 5-year period down to 0. So remember, the mechanism of what we're doing is we're taking the £120,000 and we're spreading it so that it matches the cost of that £120,000, matches the revenues that relate to it. In this case, we're saying it's £24,000 each year. And this little table is a typical format for quite a lot of accounting, but in particular, managing fixed assets. And in year 1, it shows that we start at the beginning of the year with £120,000, which is what we bought in year 0 or at the beginning of the period. We then allocate depreciation of £24,000 and left with £96,000. And in year 2, we start the year with £96,000, which was the figure from the bottom of year 1. And if you look at the overall totals, the totals at the end of year 5, just for this asset alone, show that we start off with nothing. We spent £120,000. We depreciated over that 5-year period the whole of £120,000. So we're left with nothing, which is what the running total shows us. Okay, so that's relatively easy. The question then simply would be, how do we put that through the accounts? And we'll show that in just a minute. But I want to go to a spreadsheet now, because I want to highlight something that's slightly subtle. Okay, so hopefully you can see the spreadsheet. The top part of the spreadsheet is exactly what was in the slideshow just now, and it's what we call the fixed rate apportionment of the costs. And as I said, we've allocated £24,000 each year because we know that we're getting revenues over that 5-year period. So it's quite right to apportion the costs of £24,000 each year for each of the 5 years. But remember what we're doing, we're allocating the cost to the revenues that it relate to. And in a simple example, it's fairly straightforward. But what happens if we have to spend increasing amounts of money on keeping that racking alive? Because after the first year, it's in pretty good shape. But as it gets worn, as it's more and more used, more people bash against it, and we have to spend more and more money on repairing the racking. It's actually arguable that the overall cost of the racking is not just the purchase price of 120,000, but also the maintenance costs. Yet those maintenance costs don't come equally throughout the period. They start off very low and they grow. And this is a very typical pattern. If, for example, you've got a car, the same thing happens with a car, which is much more obvious in terms of the costs, that the longer you have a car, the more it costs to run. So there's an alternative concept of allocating the costs. Instead of allocating them on an annual basis, fixed based on the £120,000, it says, let's allocate the depreciation not by reference to the cost, but by reference to how much we've got left in the balance sheet at the end of the period. So I'm going to illustrate what I mean by that. At the end of the first year, we start off the year with £120,000. As with a fixed rate, we apportion 20% of that cost. At the end of the first year, we're down to £96,000 left. So at the start of year 2, we've got £96,000. Only this time, we're going to take 20% not of the cost of £120,000, but on the balance at the beginning of the period. So instead of having £24,000, we have £19,000. And if you look at the depreciation, if we do this throughout the period, in the fixed rate, it stays constant throughout the period at 24,000 a year. But in the reducing balance basis, it decreases each year, which some people and in some businesses would be more appropriate if the other side of depreciation is, for example, maintenance costs. And then what you're doing with this using the reducing balance basis is you're apportioning the costs on a fairer way against the revenues, so that if you have a fixed amount of sales every year, you're going to get a much more even spread of costs. And that reflects the reality in some businesses better. So imagine you've got, remember we're talking about costs of £24,000. Imagine you've got revenues of £30,000. In the first example, you'll have net revenues of £6,000 a year. That's 30,000 revenue less £24,000 of depreciation. That's the £6,000. In the first year, you'll have hardly any maintenance costs. But in year 5, you might have the whole of £6,000 of maintenance costs. So what you could have is profits in the first year of £6,000 going down to profits of nil in the 5th year, not because trading has changed, but just because you have apportioned depreciation too fast relative to the maintenance costs. So the reducing balance basis is more appropriate for businesses where they increase the amount they have to spend on the asset as the asset gets older, and the purpose is to even out the cost more fairly over the life of the asset. The nice thing as the accountant is you have the choice of what you do. We talk about this as being an accounting policy. Our accounting policy for fixed assets is either the fixed rate basis or the reducing balance basis. And if you talk to an investor about the different basis that you've got, just by describing it as fixed rate or reducing balance, they will understand what you mean and how the fixed assets are accounted for, and they'll be able to make adjustments if they need to, if, for example, they're comparing these accounts with the accounts of somebody else. So all we're talking about at the moment is how much we put in the profit and loss account relating to depreciation each year. So I want to show you what that looks like in the accounts themselves by illustrating it with the trial balance. And for the trial balance, I've got accounts for the years to 31st December 21, 22, and 23. So that's the first 3 years of the charts we had. And in this example, I'm using the fixed rate basis of depreciation. So the XX is simply implies that there's a lot of other transactions going on in the annual transactions. But one of the transactions is that we bought £120,000 of shop fittings. There'll be a lot of other transactions that are going on, so this eventually would equal zero, even though at the moment it shows 120,000. If we showed the full transactions, I'm just showing the extract relating to the fixed assets. So we bought £120,000 of assets. In the first year, we depreciated it by £24,000, and we're left with £96,000. So the entries were reducing the asset. It's the opposite of a debtor or a debit, it's a credit. We credit fixed assets and we debit depreciation in the profit and loss account. So the depreciation reduces the profits we make because we're allocating that cost against the sales that relate to that cost. And at the end of the first year, we've got £96,000. In the second year, because we've got the fixed rate basis, we do exactly the same thing. We've got the £24,000 we put a journal through. Notice the audit trail. The audit trail probably takes you back to this calculation. And you'll see the second year, we apportion £24,000, £24,000 in here, same accounting journal, credit fixed assets because we're reducing the fixed assets, and we debit depreciation. Again, we're allocating £24,000 of the original cost in this year to the sales in this year because the fixed assets are being used during the year. And so on, the same thing with the third year. And at the end of the third year, our accounts show we have £48,000. Let's just double check that against the chart. At the end of the third year, £48,000, great. What this shows is how we implement this depreciation. And I just want to show if we instead replace this basis with the reducing balance basis. So this time I'm going to use the chart from the reducing balance basis in the trial balance. The first year is still £24,000, but in the second year, I'm going to pick up the £19,200. So look, the journal entry this time is minus £19,200. We credit profits £19,200, debit depreciation £19,200. And again, in the third year, I'm going to do the same thing. I'm going to pick up the depreciation in the third year, which is £15,360, credit fixed assets, debit profit and loss account. And in this way, we've reduced the cost of shop fittings that we carrying forward to future years to £61,440. Going back to the calculation, that the chart shows we've still got a balance carried forward of £61,440. So our accounts are correct. This is the unallocated fixed asset cost. And we've allocated, of the 120,000, we've allocated £58,000 to depreciation. So can you see this cost here, after 3 years, the balance is reduced to 61,000 because we've allocated costs over the 3-year period on the reducing balance basis of £58,000. And I'm just going to show what that looks like in the nominal ledger. So if you're entering using computerized accounts, we would enter these depreciation each year as a journal. And in the nominal ledger for shop fitting costs, we'd show we bought the shop fittings of £120,000. At the end of the first year, we put the journal through to put through the £24,000. That reduces the cumulative balance from £120,000 to £96,000. Depreciation for the second year is £19,200. For the third year, £15,360. And at the end of the third year, our nominal ledger or a general ledger, our account for shop fitting costs shows a net cumulative balance of £61,440. That's what the computer would show. But if we're doing this with the reducing balance, when it comes to using the computer, it's quite easy to get the calculation of what depreciation should be, because it's always based on what this cumulative balance is. And it's very easy to do the calculation. The shortcut calculation for depreciation is simply 20% of the previous year's net book values. But if this wasn't the reducing balance, if this was the fixed basis, so imagine this now showed minus £24,000 again. When we're doing the shortcut for years 2 or years 3, it's not so easy to remember how you calculate £24,000, because you've got to remember that the cost was £120,000. But when we're doing the fixed rate basis of accounting, there's a different way that we do the accounting for it. And we actually set up 2 separate nominal accounts. One nominal account is just for the cost itself, and the other nominal account is for the depreciation. They both go within fixed assets, so they're both in the fixed assets section. But here, when we put through our purchase, our journal, we put through, we credited bank or however we paid for it, we reduced the asset, and we debited the fixed asset, which is shop fitting costs. Then at the end of the first year, instead of putting the depreciation through to the shop fittings cost account, we put it through to the shop fittings accumulated depreciation account. Same thing in the second year, same thing in the third year. And the reason this then becomes very easy is if you want to calculate a shortcut way of calculating depreciation, you can simply look at the total cumulative balance on your shop fitting costs of the year and multiply it by 20% or whatever your depreciation rate is. And it's very easy to calculate the depreciation. And once again, the cumulative balance on the nominal cost and the cumulative balance on the depreciation, if you net the 2 off together, give you the correct trial balance figure. So, final thing I just want to mention is how you show this in the statutory accounts. And in the statutory accounts, there's a traditional format. You show the previous year in the following column, and the current year is in the first column. And for various reasons in the statutory accounts, we separate out the cost from the accumulated depreciation to show the net book value. And the reason we do it this way is to give users of the accounts a sense of how old our assets are. And when we come along to looking at the balance sheet and analysing the balance sheet at some stage in the future, you'll know that the older the assets are, the more likely you're going to need cash flow to buy new assets. So the reason we set up the notes to the accounts in this way is to give us a hint as to how old our assets are by looking at what the accumulated depreciation is relative to the cost. So if your accumulated depreciation, so I'll explain this. So in the section that we have, we always start off with the balance as at the beginning of the period. I'm going to start with the previous year. So in the previous year, we started off with nothing. We bought assets for £120,000, and we ended the year with a cost of £120,000. again, we had no accumulated depreciation at the beginning of the previous period. We depreciated last year £24,000, so the accumulated depreciation is still £24,000. We've got net assets, net book value of £96,000. So in this year, we start off with the same £120,000 we ended off last year as costs. We didn't buy anything new, so we've still got costs of £120,000 at the end of the period. But with depreciation, we've added a further £24,000. So we've now got £48,000 of accumulated cost, or £72,000 of net book value. So already, if you're analysing these accounts, you can get a feel for how likely it is you're going to spend money on buying new fixed assets. And in the year 2022, the answer is not that likely because we've still got quite a healthy net book value relative to the shop fitting, the total costs. So that's the statutory reporting. So far, so good. But I want to show you a potential problem with the basic premise I gave you in the shop fittings, which is that you simply, the shortcut is you simply take whatever the total retained cost is of your fixed assets and multiply them by 20%. You do that each year, it's a shortcut. But this is a problem I want to identify for you. In this example, we bought the fittings, so this is the nominal ledger, we bought these fittings for £120,000. At the end of the first year, we allocated depreciation of £24,000, we're down to £96,000. Then we allocate depreciation in the next year of £24,000. We allocate depreciation in the following year of £24,000. And look what happens when we get to the fifth year, 2025, we've depreciated all of the £120,000. There's nothing left in the cumulative balance. But if we don't keep track of this net figure, look what we do in the following year. If we simply allocate 20% of the £120,000, in the following year, we allocate another 20%, and then the following year, another 20%, and we're down into negative territory. And what we're doing is we're allocating costs to the profit and loss account that don't exist. So we're actually making a mistake if we account for it. Now, if this is the only transaction, it'll be very obvious that that's what you're doing. And you wouldn't need anyone to tell you that you would stop after the end of this year because your fixed assets figure would go negative. But what happens if in this year, in the third year, we buy another £40,000 of assets? So we bought £40,000 of assets. Look what's happened. Sorry, we bought £40,000 of assets. Our depreciation has gone up to £32,000. But look what happens at the end of year 5. If you remember, that was the year in which our fixed assets had gone to zero. But at the moment, we've still got £16,000 of fixed assets. And we're now going to put through a further depreciation charge in the following year of £32,000. But wait, that £32,000 represents both depreciation on the £40,000, but also depreciation on the £120,000, which is now fully depreciated. So in this year, we're over depreciating and we don't see it. At the end of the year, it looks like we got a cumulative balance of £16,000. We wouldn't know that we've over depreciated. So that's the potential problem. Again, let me just remove that. No, if we haven't got any purchases, it's very obvious at the end of this year that we need to stop. We need to stop depreciating £120,000. But if we put some purchases in during the period, at the end of the fifth year, we're not down to zero. So we're not triggered that we should stop depreciating £120,000. And indeed, we wrongly allocate depreciation in that year. So what's the solution? The solution is to use something called a fixed assets register. A fixed asset register distinguishes each asset that you've got. So if you've got a car, you distinguish that from a fittings, but if you buy two different types of fittings, you would distinguish one from the other. So in this case, we bought some fittings in 2020. Our designer might have thought we need to spruce up what we're doing and have a new set of a different type of fittings in part of the store in 2023. So the way we account for this is in our register, we keep track of our cost and our depreciation separately in our net book value. So our net book value is simply the difference between the cost and the depreciation each year. But look now, so at the end of year 5 in 2025, it's very obvious we have to stop depreciating from then onwards. But look what happens when we now buy our £40,000 in the following year. Our register is separated. This £40,000 doesn't go into our first register, it goes into the second register, the 2023 purchases. And we've got our depreciation schedule relative to that. And we can see that at the end, we need to stop depreciating at the end of 2020, at the end of 2027. So because we know we've got to zero, we would simply delete this. But look what happens with this depreciation for 2026. If you remember when we over depreciated it, we were going to depreciate at £16,000. When we've solved the problem, we've stopped depreciating the first lot because we fully depreciated it. We only depreciate the second purchase of £8,000, and our depreciation schedule now gives us the correct figure. So using a fixed asset register, this is the way we can avoid the error of combining assets and fully depreciating one and going on depreciating it because we've mistakenly mixed it with another set of assets. Now, for reasons you may be able to work out, this doesn't apply if you use the reducing balance basis, because with the reducing balance basis, you actually never finish depreciating. Let's just have a quick look at that. If you remember, this is the original chart on a reducing balance basis. The reason you never fully depreciate is because you only ever depreciate based on a percentage of what you started off with. So as long as you never start off with a negative figure, your depreciation is always going to be less than what you start off with. So you can never fully depreciate your assets. Okay, so fixed asset register and on computerized accounting, most of them have their own means of helping you keep track of fixed assets using their own register. That's why we keep a register. You don't need to do so if you're using the reduced balance basis. But if, as most people do, you're using the fixed rate cost, which is much easier, much more instinctive and much more understandable, then you want to use a register to avoid over depreciating if you need to. And remember, the idea of all these manual adjustments, manual calculations rather, is to allow us to put the journal through into the accounts through either the trial balance by way of journal or in the computer accounts in order to get the allocation of the costs into the correct accounting year. So I'm now going to come through a second issue with fixed assets, and that's what happens if you sell the assets. So I'm going to go back to the shop fittings, and at the end of the third year, we've depreciated 3 lots of years. Our net balance show we've got unallocated costs still of £48,000. We started off with £120,000. We've apportioned £72,000 of the profit and loss account. We've got £48,000 carried forward of unapportioned costs. And if you look at the register, you can see these figures here show the same figures. What happens at the end of the third year if we sell the assets? Well, if we sell the assets for £48,000, we don't really have much of a problem. We've got a bit of a problem, which I'll explain in a minute. but we don't have a huge problem because we're getting exactly what the cumulative balance was in the accounts. But it's very, very rare that you predict accurately what the sales price of assets will be at the beginning of when you purchase the asset. It's very difficult to know what the price will be when you sell it. You have to guess or estimate. And in this particular case, our estimate was that we'd have £48,000 of unapportioned costs at the end of 2023, when actually on the 31st of December, someone comes along and says, I'm going to buy your fixtures for £40,000. And if our designer has had enough of a go at us and say we have to update the fittings in our store, we need to change our image, we may well say, okay, I'm going to sell the assets for £40,000. Frankly, it's better than I worried about. If I don't sell them, I've got to throw them away. So I'm better off to sell them for £40,000 than nothing. The problem is, how do you account for the fact that we've got unallocated costs of £48,000, but those assets are now only worth £40,000? And the answer is, we split the transaction into two. The first part of it is, we're going to remove the cost and the accumulated depreciation from our accounts. So we're going to put in an entry. Let me just move this out of the way. We're going to put in an entry, 31 December, sale of assets. And I'm going to put in a negative figure of £48,000. And that reduces the cumulative balance to zero. And again, I'm going to do the same thing here. I'm going to show my sales, but this time, instead of showing minus £48,000, I'm going to split it between the cost and the depreciation. I'm going to reduce my cost by £120,000, and my accumulated depreciation, I'm going to remove £72,000 of that to come back to zero. So as I said, what I've done with the sale in my register, I've reduced my cost by £120,000. I've removed it. I've also removed the depreciation. So I have removed £48,000 of net book value from my nominal accounts. And I want to show you what that looks like on the trial balance. On the trial balance, we started off at the beginning of 2023 with £72,000. We depreciated £24,000, but now the whole of the £48,000 that we've got left is no longer an asset, is no longer to be carried forward. So we need to reduce the assets by £48,000. And if we look back at the register, that £48,000 represents cost of £120,000 and depreciation of accumulated depreciation of £72,000. And if we had two accounts instead of one on here, if one was shop fittings and another line was shop fittings accumulated depreciation, we show those two figures separately. In this, I've just lumped them together. But correctly at the end of the period, we're showing we've got no costs left that are unallocated because we've sold the costs, we sold the assets. And look, we're showing in our bank account that we've received £40,000. So here's a challenge. We've received £40,000, but in our books showed £48,000. We've lost £8,000, or more technically, we've got £8,000 of costs that we bought when we first purchased the asset that we still haven't allocated to profits, but yet we've got no more assets to carry forward. We're not going to be using those assets against future revenues. What's the other entry, the other double entry? So we debit bank, because that's the money that goes into our bank. We credit fixed assets of £48,000 because we eliminate the cost, the £48,000 that had been in there. We reduce it to zero. Debit bank £40,000. Credit shop fittings of £48,000. We've got £8,000 of debit we still have to allocate. The answer is we allocate it So the same place we allocate depreciation. So we debit the profit and loss account. That £8,000 is treated as a loss in the current year. Now, if you could go back in time, you would say, look, that £8,000 should actually be spread over the 3 years equally, but we've already accounted for the first 2 years, so it's too late. So the best we can do is write off the difference in the current year. So even though if you look at the 3 years as a whole, we have this big hit to our profits of £8,000 in the current year, that's simply the way the cookie crumbles. It's because we've already allocated all the costs and we have to now release the balance. Conversely, if we receive £50,000 instead of £40,000, that £8,000 cost would have become a £2,000 profit. So it can go either way. What we're doing is we're releasing any unapportioned costs or revenues, of course, to the profit and loss account in the year in which it happens. So in this case, our total cost to the profit and loss account was £32,000, of which £24,000 was depreciation and £8,000 was the loss on the sale of fixed assets. The final thing I want to do is to show you what that looks like when you're reporting it. So when we're reporting it in the accounts, we show £120,000 brought forward, or start again. Our costs of our costs at the beginning of the period were £120,000. We've got no purchases. We have a new line in the cost section saying sale of fixed assets in the year. And in this case, we sold £120,000, which brings our cost to zero. And in our depreciation, we started off with accumulated depreciation of £48,000. We had a further £24,000 of depreciation in the year. We've now sold fixed assets. The sale eliminates that £72,000, which leaves us with no accumulated depreciation at the end of the period. Our net book value is down to zero. So that brings us to the end of the fixed assets module. I hope you understood a lot of the concepts of them. It's actually much more straightforward when you're doing it. I spent quite a long time describing it because I wanted you to understand the principles by which you can allocate the costs to the period in which the revenues relate to those costs. And I was illustrated that there's more than one way of allocating the cost depending on what you think suits the business best. We've been through how you put that through the accounts and how you record them and how you report them in the statutory accounts and to management if you need to do so. So thank you for listening. Keep well. Bye.